Welcome back, folks. In this video, I want to walk you through last night's New York session long on gold. Okay, I've journaled that here on my Twitter profile. Like all my trades, go and have a look at the markup. Okay, now here again we see the dump. Okay, dump for the pump, and we have a very well executed trade here from the 9:30 a.m. session, which is when the New York equities market opens, and that is the best time in my experience to trade the gold market. Okay, 9:30 to 10 a.m. will typically make the low or the high in that New York session. Okay, so if I'm seeing the market dump down, we're at the low of the day, okay, and coming to a support zone, okay, a real support zone. This here is a rejection block midpoint. Okay, you can have a look at that on the 4-hourly chart. At 9:30, with all that I can see in the charts, I'm going to be expecting this level to hold, right? Knowing that 9:30 will either be the low or the high. Okay, we're already at the low, so I'm already expecting long. We've seen a dump in the market. We're coming into a key true support zone, okay, midpoint of a 4-hourly rejection block, and we have liquidity residing above, okay? So on this day, you've got to ask yourself, this is yesterday, okay, Monday, why is the market going down? What's the reason for the market to go down? Well, there isn't any reason. There's no news on the calendar, okay? So Monday, blank news. And so you've got to think to yourself, why is this market moving? And it's all manipulation. So you're looking for a move back up, okay, at the right time where liquidity resides. So I want to walk you through this trade. Very well executed trade, very easy to spot. If I just jump down to notice this fair value gap, okay? When you have two consecutive fair value gaps, I highlight both of them, okay, because it just simply means it's one gap on a higher time frame. Notice that we have equal lows just above the fair value gap. We also have this liquidity, right? This is a low. So all of this and these equal lows and this fair value gap is what this move down is reaching for. In particular, the 4-hourly rejection block, okay, a rejection block, which is a big wick, okay. Midpoint of that is where you will find the market will typically hold on the way down or hold as resistance on the way up. Okay, this here yellow line, these yellow lines are always midpoints of some fair value gap or rejection block. Okay, this again you can see we're seeing that price is being held here. I don't expect it to remain there. I do think we'll go higher. Let me break this down a little bit more on a 5-minute chart. It was quite easy. It's a lot easier to see on a 5-minute chart. Okay, so we've moving down, crawling down. Notice that there's up down, up down, up down candles. You'll see that when the move that's in play is about to end, you'll see a change in the candles, right? So notice we've got all down candles, and as we're coming closer to where it wants to go, you start to see these up candles. Okay, that's a first indication that there may be a change or the move may be ending. There's that fair value gap that we're coming into. Okay, that I've shown you. And there is the midpoint of that rejection block on the 4-hourly chart. Okay, so we've got nice displacement. Okay, so you have your breaking structure on this time frame. Okay, so now you're making a new high here above this, and this is really just a pullback and a stop hunt. Okay, this is now your 9:30 candle. Okay, I love this impulsive move up. This is a common sequence of candles you'll see. We have a impulsive move up where that's kind of the inducement where it gets everybody long. Okay, also takes out anyone that may be short on this move down. Okay, from these stops above this swing high, but then you get this immediate down candle, and that's your order block, okay? Nice, clean, big down candle coming right into the midpoint of that 4-hourly rejection block, taking out all the liquidity, okay? And that's inside of that 9:30 a.m. candle, okay? 9:30 to 9:45, 15-minute candle, okay? And that's where I've entered, okay? As this has started to move up once it's hit my key point of interest that I've marked out on the chart, okay? Now, somebody had a question about a runaway gap, okay? Not something that I use in my trading, but this is going to be a runaway gap, and that's because you have a bullish breaker. We're not expecting the market to come back down into this order block. It can, but you don't want to wait for that when you have a bullish breaker. So we have a low here, okay? This is a swing low, okay? You have a swing high up here, right? And then you have a lower swing low, okay? So expectation as people are watching this market will be that you've got a move from ladder high, high to low. So the trend should really be going down as it has, and then the next move should be going lower, but we don't have that. In fact, what we have is ladder high, okay, and then we get a lower low, but then you get a higher high, okay. So that's a change in the direction of the market. And so when you have that, you've got your lower low, or you've got a low here, okay. You got a high, but then you have a lower low, okay. It's when you get this higher high that you should be interested in the market, because then these two bullish candles in this swing high, okay, in this swing high, these two bullish candles are going to be your bullish breaker, and that's where after this move, right, high up here, that's where we come back down into. And so therefore, while the market can come into this gap and into this order block, you don't want to wait for that. Okay, now I don't use breakaway gaps. I don't even look for them. I use the more easy to identify ICT signatures, and this bullish breaker is the easiest of them all. Okay, and you can see we've come into that zone after making this higher high. Okay, and so quite a straightforward trade. Okay, you're looking for these dumps, right? We're dumping in to rebalance a fair value gap, also to stop out existing longs from Friday, okay, that are holding on to this, coming back down to balance the market in terms of those big long wicks that you see on those 4 hourly charts. They're going to be very important. Okay, have a look at those. When you have a big long wick on a 4 hourly chart, draw out the midpoint, because those levels are going to be very important for the market. And that's what this dump has done. I'm always looking for the dump for the pump, or the pump for the dump. Okay, so that's quite a straightforward trade. Entry at 9:30, as you can see. Where's my journal? Okay, so entry at 9:30 had a nice size because it was high probability, low of the day. 9:30 key time, key price points, that's time and price. But more importantly, dump for the pump. Okay, why is this market dumping down? There's no reason for the market to move. There's no news on the calendar. Where's the volatility coming from? It's just manipulation. That's the key, right? That's what you really need to understand. Okay, notice also that this little move down, look at the chop. Okay, that's not the real move. So you know the chop starts here. This is the inducement. Okay, people going along from here. This chop tells you that this is just a manipulation. Okay, then the move really starts. If I just draw a little box around that little area, the move really starts from here. We have this up candle, which is manipulation. Okay, inducement again to go long, take out anyone that's already short from these two down candles, and then a impulsive move down that stops out existing long holders from this level, takes out all that liquidity. Okay, and then an impulsive move higher. Now, you may not get this entry at 9:30, okay, because that takes time and practice and understanding how to read the tape, understanding how price action behaves, or you just might have the fear with this down candle that is what it's designed to do to prevent you from going long. But you can certainly look at the structure that's being developed and engineered, okay, which is this low and high, okay, and lower low, then a high high, okay, and then look at these up candles in that swing high and wait for the market to push back down into that bullish breaker. Okay, now that's also happening at a key time, right? So the time that you get that move down is inside the last hour for the session. That's a second 15-minute candle inside the last hour of the New York session from 10 to 11. Again, notice that it's a new hour and it's within that 30 minutes of the new hour. Okay, 9:30 is the second hour of the New York session and it's 30 minutes within that second hour. So these times are critical. Okay, so the target was two targets. Okay, so on this impulsive move, first target was these equal highs. Okay, that was the first exit 2502, I think it was. Let's have a look. Yeah, so 2502 was the first lot that I've taken off. The second lot was 2507, which was the equal highs a little bit further up above these horizontal red line. Okay, equal highs. We've gone straight through there. Okay, and it's as simple as that. Okay, now I know that when I say it's as simple as that, a lot of you think, well, it's maybe easy for myself, but when I was learning and my mentors were saying, you know, it's easy. I used to think the same thing, that it's easy for the teacher, and I also used to think that why can't I see it? Okay, there's only really one reason, right? I'm not doing anything special. Okay, this is not something new that I'm doing. These are very basic ICT principles that I have learned by studying the charts. Okay, if you really want to get good at understanding price action and being able to identify the ICT signatures in real time, you need to study the charts. Okay, you need to monitor the charts in real time so that you can see how these candles are forming, how the setups are forming, at what times and at what levels. Okay, it's not until you look at the markets live and kind of start to piece together the story the chart is telling you. It's not until you do that and monitor it on a daily basis in real time, you won't understand what's going on. It's going to be more difficult. Okay, you can't just watch the video and turn it off. You've got to do the study. Okay, so dump for the pump. Now there was also a pump for the dump. Okay, so this move down was also at a key time. So I'll jump up to a 15-minute time frame. Again, all these things happen at key times. Let me turn off all these lines now because it's quite distracting. So I'm going to show you a couple of things here. So here, this here is 3:30 a.m. Again, it's a new hour, okay? And 30 minutes into that hour, you get this pump up. Whenever you see 3 candles, okay, that's when you want to pay attention, because 3 candles, I think that's the magic number. That's a 45-minute pump up, okay? That started at 3:30. That's taking out liquidity above. Okay, and then moving down. So that's a pump for the dump, and that's that dump that's going to that key level of rebalancing that the market needs to do. Okay, and then we have a turnaround at 9:30. So key time, London will always give you an entry unless there's news at 8:30. You'll always find an entry at in a London time, which is either that 2 a.m., which is the second hour of London, or 3 a.m. Okay, a new hour within the London session. 2:30 is my favorite time. Okay, it's 30 minutes inside of that second hour of the London session, and 3:30 a.m. is also one of my favorite times. You also will get moved at 4 a.m. Now, when I talk about these times, the move is going to happen at one of those times. So your job is to look at what's going on in the market at those times. Okay, your setups need to form at that time. So here, the pump has formed at 3:30. Okay, and so why would you be looking for a pump for the dump? Well, because you can see in Asia, you've had this bearish signature. Okay, so in Asia, you've had these bearish order blocks form, okay? This displacement down with fair value gaps, right? Okay, so fair value gap, and then you have these two down candles, okay, that need to be traded back up into as well as a mitigation, right? Anytime you have a sell to buy and a sell, you've got to look at where it's got to come back up to mitigate, okay? These up candles, your bearish shorter blocks, and these two down candles as well. Okay, so you have a bearish signature on this 50-minute chart. All this pump up is, so you're bearish, right? Your stance is bearish. This is now chop, 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 right? This is a pullback. 330 get the pump up into these bearish order blocks, okay? And then you get the move down, okay? So you could have traded, a trader could have traded that move down, okay, for the London session, or the move back up in the New York session, also targeting liquidity that resides above, okay, which is where I've marked my exit, okay, that's where I've taken my exits. So that's incorrectly labeled, that's buy side liquidity, okay, and then you've got equal highs here as well. We've taken partials, okay, so you can see the exits here at 2502, which is that level there, 2507, which is that level there, okay. So again, as I say, it's nothing new, nothing that I've invented. I'm nobody special, okay. Anybody can do this. My teachers used to say the same thing, that if they could do it, anybody can do it. And I say the exact same thing. If I can do it, anybody can do it. And the only difference is the one who studies the most, the one who practices the most in terms of looking at the charts in real time, looking at price action, looking at someone who's telling them what's happening in the market, and then going back and looking at those things that the teacher has pointed out on their own charts, right? You've got to spend the time studying the charts, looking at what I'm pointing out here, looking for the signatures, trying to understand where is the draw on liquidity. Okay, so let's talk a little about what's next for this market. Okay, so as you know from my analysis, I am now directionally biased to the downside, okay, and all this is really doing is creating liquidity, okay. So if we kind of shrink this chart down a bit, okay, we now have liquidity down here for the market to come down and take. Everybody's long from that level, okay. We've got relatively equal lows, and as I said, there's nice equal lows down here. Let me just start to draw some of this so you can see. So nice equal lows here, okay, at that what's that, 2450, 247 at 7.50. There's a fair bit of gap in here. I've spoken about this already, so go back and look at the previous videos. Okay, let me actually move this over so that I can use this easier. There we go. And so this move down yesterday, to me, this is just building liquidity, right? The market needs to build liquidity for its intended move, which I believe is to the downside. Okay, that doesn't mean that we won't take out these highs. Okay, these are relatively equal highs. When the market is ready to go down, it's going to, whip people out. Okay, so it'll take out existing short sellers. It'll probably first take out existing long holders, go back up, take out existing short sellers, and then reprice lower down to its objective. So it's going to be, as I said in my previous video, longs and shorts are going to be trapped in both directions, okay, before it moves. Ultimately, this is what I'm looking at, and then there's lower targets on a higher time frame. Now, I think today is probably going to be a small range day, okay? Again, there's no news on the calendar, so if this market does move, today's Tuesday, this is CAD news. I don't expect to be, that to have any impact on the gold market. So if the market does move, you've got to ask yourself, why is it moving? Okay, it's just them trying to trap traders and build the liquidity for their intended move, which I think will be sometime Wednesday or Friday. Okay, Wednesday, Thursday, Friday, I do expect the market to be very, very volatile. Okay, so it's all manipulation right now. Liquidity is what they're building on both sides. Okay, and then they're going to be doing something which, takes out both sides of the market before the intended move. So they'll take out the folks who are long, then they'll take out folks who are short. Okay, and then most likely a big, massive move in one direction or the other. We still could go higher. Okay, anything's possible in this market right now. So it's all about looking at the time, looking at when they are going to inject volatility, which will be at those key news announcements, looking at what the setups are, looking for that pump for the dump or the dump for the pump at those key times, okay? You've got to be able to read the market by understanding how they book price, and you're only going to learn that by going back and studying the charts, okay? The purpose of my videos is to highlight how I'm trading and what I'm using, okay? What ICT signatures I'm using, what I'm looking for in the day to be able to identify those setups. That's what you need to learn. You need to go back and look at these on your own chart so you can also identify what I'm looking at in real time, okay? Now, my results are not typical, okay? It all comes down to your availability of capital, your risk tolerance level, okay? Your psychology, your understanding of price action, your understanding of the markets, how they book your experience. There's a whole range of things that need to be taken into consideration, but it's all relative, okay? So the size that I trade is relative to my account size and my level of risk that I am comfortable with, okay? For everyone else, it may be very different, okay? Often, retail traders are not disciplined. They're not patient. They'll trade at the wrong times. They won't be able to correctly identify the setups. They'll incorrectly identify the signatures, okay? They'll trade against the higher time frame directional bias, okay? They'll get trapped in the manipulation that the market makers use. So there's a whole range of things that need to be considered. So don't look at these numbers and expect that you can also do it as easily as I show it in the video, okay? There's a lot more to it than that. It takes a lot of time and practice and being able to read the charts, understand price action, and then also have the mindset, okay, and the discipline and the ability to identify the setups at the right times, okay? So I hope the video is useful. I will now talk with you in a future video.